of the previous generation. So here to tell us more about this Trainium 3 chip and also what we learned at Amazon's conference. We're speaking with someone who is at the conference right now. We're speaking with Patrick Moorhead, CEO and Chief Analyst of More Insights and Strategy. Patrick, good to see you again.
Yeah, great to see you too. Another week, more chip talk.
More chip talk. It never gets old. And you're there. How is it? How's the conference?
It's really big, and I mean, it seems to take over 2 or 3 hotels, and AWS is in so many things. They're a full stack company, and so they're basically doing everything. And there are a lot of people here who are interested to hear what they have to say and how to get involved and how to do comparisons to other tech vendors.
Yeah. So the big news coming out of the conference is this Trainium 3 chip, which is better, faster, stronger, all of the above. Tell us about the Trainium 3 chip. Why is this important? Is it important? Yeah. What does it mean for the chip race?
The simple way to think about Trainium is if you've done, I think we talked about the TPU before from Google. This is Amazon's version of an ASIC. And like Google, they use GPUs as well. But when it comes to AWS's very close-knit development network and the software that they run for AI, it's really the standard for that. And the other fun fact here is that Trainium is the chip that powers Anthropic, who we can debate whether it's OpenAI is number 1 or number 2 to Anthropic, but those are the 2 big platforms. You got Microsoft with OpenAI. You have AWS with Anthropic, and you've got Google. And now everybody is working with pretty much everybody now because they just need capacity and they want choice.
Right. Some of the stats I've seen, Trainium 3 is 4 times faster than the previous models. It can also train models at half of the cost. Sounds good. But I'm almost more interested in how does it compare to other chips? Do we know anything about how Trainium would compare to, say, NVIDIA's blue chip GPU chip or Google's? How does it compare?
Yeah, so again, I'm going to just simplify this. A lot of details that go along with this, but think of NVIDIA Blackwell. If you want the highest raw performance and the broadest software ecosystem, you go with Blackwell, right? It's expensive hardware, very strong performance per watt, and it's everywhere. It's in every cloud. Trainium 3 is the best TCO inside AWS for their workloads that you're willing to port to. And it's not necessarily a raw performance leader. And then you've got Google TPUs, Trillium and Ironwood, cost-efficient, high-performance training inside of GCP, particularly if you're tied to what's called JAX. That's kind of like the CUDA equivalent. And then, AMD, right? Competitive to slightly better compute and memory footprint versus Blackwell, lower levels of vendor lock-in. Software is still catching up.
So one of the things that I keep on seeing online is are these benchmarks trying to measure which one is the best, which is better than the other. And I can never tell whether to take it seriously because it seems like it's changing all of the time, or whether I should not. And I'm starting to think that maybe just the best benchmark is just the market. Whoever sells the most is the best. Is this a impossible game to figure out which one is the best?
So the short answer is yes. And I've served on benchmarking committees before. I was an ex-executive at AMD where we did benchmarks, and having benchmarks are better than not having benchmarks. They're only good at a certain point in time, a snapshot, and what matters is the type of workload, right? Is it FP4, FP8? Is it written in CUDA? Is it JAX? Is it something different? So there's a lot of variables, but you nailed it, Ed. The market does speak, and what happens before any of these companies make a giant investment is they go through the architecture, they run their code. But right now, because OpenAI and Anthropic are all running on everybody's hardware, right? That shows you their certainty, which is they're uncertain, and they want to support everything to see in the end which one has the best total cost of ownership.
Okay. Patrick Moorhead, CEO and Chief Analyst of More Insights and Strategy. Patrick, always good to hear about chips from you. I hope you are enjoying your time at the hotel, at reInvent. Where is it?
It's in Las Vegas, right? The
Las
only
Vegas.
city
That's fun.
big enough to hold a conference.
Congratulations. Your idea that you actually came on the podcast and discussed, it's now a reality. You founded the nonprofit group Invest America, which was really the force that made this happen. Let's just start with that. How did this all come about? What does this mean for America?
Well, I think it's transformed. First, thanks for having me on, Ed. It's great to be back. And, I know how much, you and Scott, worry about and think about the fact that too many Americans are left out and left behind, not in the game of capitalism. And when I was on before, I said, this will be transformational if we get it done. This is a platform that literally creates universal private ownership from birth, a 401k from birth, that gets every child, 3.7 million kids born a year, gets every one of those kids into the game. Now, think about this, Ed. Under the age of 18, that's 65 million kids. And of those 65 million, 50 million would never own an account that compounds. Yeah. And now they will all own an account that compounds, that's aligned with the upside of capitalism. And we know, unless you have a compounding asset in this country, like there's no chance that you can keep up with the cost of living increases, et cetera. And so I think in that regard, it's a game changer. How did it come about? Well, I've been working on this idea to first get it passed into law for 4 years. And we were working with both sides of the aisle. You probably saw the letter out today with Cory Booker and Ted Cruz that went out to 1,000 chief executives asking them all to contribute money into the accounts of our kids. And, I've been working with both of those senators and many other people on Capitol Hill across the political spectrum. And we were prepared. We tried to get this done with Biden. As I explained to you guys, we didn't make a ton of progress there, even though we had a lot of support. And we had an opening with this president. Michael Dell who's a good friend, played a key role in brokering the final relationship. He and I went and saw the president, and the president loved the idea. He made the final call to the speaker that got it included in the reconciliation bill. That occurred in April of this year. Now, fortunately, we already had the beach softened in the House and the Senate. So when the president made the call that he wanted to see it in the reconciliation bill, we had already the draft of the Invest America Act on the Senate side. We dropped in the language. So it's pretty easy from there to get it included. And then, of course, the bill passed, which, let's just stop there for a second. I mean, this is a change to our social contract on the order of magnitude of Social Security itself. The federal government's going to launch the largest consumer project in the history of the federal government, 60 million accounts for every kid under the age of 18. And so I think it was extraordinary that we were able to get that accomplished in the law is a fact to celebrate. But as you know, that was never what this was about. It wasn't just, getting it passed into law. It was then executing it and making sure that we turned it into a platform for change.
Just to put it out there, I think most people know this, but I think it's an incredible idea. I'm really excited about it. Just the idea that, so many people are losing their faith in the system. And a lot of that is because they've been left out of the system. So what are we doing here? We're automatically buying you into the system by investing you in the stock market, in just low-cost index funds, which we should really all be invested in. But I want to play devil's advocate and just throw out criticisms that I've been seeing online. One criticism I've seen is this just makes rich people richer because rich people already own stocks. And so now we're putting more capital into the market, so they're going to get richer. I've also seen people say, oh, if everyone gets an investment account, then that's like no one getting an investment account because you're not actually getting ahead. And then I've also seen another criticism, which is this is billionaires appeasing the president. This is a big concern with this administration. Michael Dell gives $6 billion and gets in good with Trump. I just want to hear what you would say to those criticisms.
Yeah, let's first start with this idea of the rich getting richer somehow, because I think this is the biggest fallacy, Ed. Listen, the rich already have a lot of money. Rich kids already have a lot of money. So the fact that they have an account is somewhat irrelevant to those kids Because remember, in this country, we have something called 529 accounts, right? There's 16.1 million 529 accounts. These are accounts for college savings. 15.8 million of those are owned by people in the top 10% of income. Okay. They already have all their kids already. My kids have these accounts. That's how, in fact, the motivation, the story with my kids, how Invest America started was my older son, Lincoln, said, Dad, this is great that we have an account, but what about all the kids that don't? That was really the inspiration that drove this. So those kids are doing fine. This takes the 50 million kids who would never, not only as children, but never in their lifetime, have an account that compounded with the stock market and getting them into the game up from birth. So by definition, they disproportionately benefit because the alternative is zero, Ed. Right. And now these kids, if they start with $1,000 and an employer or mom and dad or a philanthropist adds just $750 a year, that's $50,000 at the age of 18. That's $150,000 at age 30, and it's $1 million at age 50 or 55 using the 75-year track record of the S&P 500. So undisputably, this will disproportionately benefit those who have less. And let's talk about the Dell contribution. A key component of their announcement, Ed, was that their $6.25 billion is only going to families that live in zip codes where the average income is less than $150,000. So they're excluding the highest earning zip codes in the country. And so I think you're going to see a lot of that as people start announcing additions to these programs, the philanthropic contributions, the corporate contributions. I think a lot of those will be income-based. And so that will also help to ameliorate that. Secondly, let's talk about this question of billionaires appeasing the president, right? There's no doubt, right, that I think in all administrations, you have people who are currying favor with administrations, doing things that administrations, might like. And, when it comes to this president, certainly he's closer to the business community than Biden was. But I'll tell you, if you look at the people who are, in the White House, it's Democrat and Republican CEOs across the board. Even if you just look at the day that we announced, had the Invest America Roundtable, Dara Khosrowshahi, who's been a critic, I think if you follow his Twitter feed, pretty clear he's on the left of a lot of issues. He was there and he praised this program. Cory Booker and Mark Warner, lots of people on the left. The Clintons have been big supporters of this idea. And so, this is a big bipartisan tent. And so the fact that Michael Dell, who nobody views as a diehard or super conservative, raging Republican, steps forward and says, listen, I'm going to do this because my foundation has been investing in kids. And the number one thing they like about it, Ed, if you want to give away $6 billion, okay, and you have to give it away today, how do you do it? You give it to a charity and then the charity somehow gives it to kids, but how much actually makes it to the kids, Ed? Right? And how do you track what makes it to the kids? And as entrepreneurs, a lot of people want to give away a lot of money, but they want it to be performance-based. They want to know that it makes it to the kids. They don't want some charity apparatus in the middle to take half of it. So for the first time, we have a direct giving platform where these folks can give away billions and billions of dollars at scale. They know it goes directly into the kids' accounts. Nobody's taking a scrape in the middle, and it's going to compound according to the rules that have been promulgated, which means that the kids can't take the money out, right, until they're 18. And then at 18, they can only use it, a part of it, to buy a home, start a business, go to school, or it rolls into the IRA retirement rules. And so now we've set up a platform. I think of it a lot like, iOS, and now these are the applications that are getting built on top of it. We now have a universal operating system for kids. It's universal ownership, private accounts from birth.
Yeah, it certainly seems as though this is perhaps the infrastructure through which the ultra wealthy can start giving away money back and investing it back into America. Michael gave away around 6% of his net worth. I'm waiting for someone to match him. Yeah. I'm waiting for someone like a Zuckerberg to get out there and match him. Do you think that that's going to happen? Are we going to see more mega billionaires or just wealthy people in general contributing to this program?
We know Michael and I are leading the Invest America Giving Council. We're calling everybody who's signed on to the Giving Pledge. These are a lot of our friends, and I can tell you our phones were blowing up yesterday with people who wanted to sponsor states, right? The state of Texas or California or Indiana or Wisconsin or Ohio, to give to all the kids who are born in those states, who wanted to adopt cities, who wanted, to follow Michael's lead. And I see you're going to see major announcements in this regard. And by the way, those were with people, CEOs, entrepreneurs, and billionaires on both sides of the political aisle.
Yeah.
And Michael and Susan were bold and entrepreneurial in going first, right? They were going to take the shrapnel to the extent there was any. And I think now it's made it safe for other wealthy people to follow. But let's not just focus on the ultra wealthy. We have a long tail of extraordinary philanthropy in this country, right? And so there are going to be people who adopt their school, right? It may be, or maybe adopt a grade in their school, say for all the kids in this grade, and they'll work with their school to make sure that they contribute to every one of those accounts. There are going to be churches who raise money to make sure that all the kids of the church get money added to their accounts, right? There are going to be moms and dads that just say, all the friends of ours who have kids. I will tell you this, Ed, the number of children that have been born into my life. I did this with all my nieces and nephews when they were born, but it was hard. I had to set up custodial accounts for them, right? Yeah. This will be the best baby gift or birthday gift or bar mitzvah gift you can possibly give to anybody, right? None of us really have good creative gift ideas. Now we can just give them $1,000 worth of stocks and, let it grow and compound. And so I think, yes, the head end of philanthropy is going to be potent. It's going to be great. I myself am looking at adding to the accounts in the state of Indiana, where I'm born. State of Indiana, there are 87,000 kids born a year. And so I'm talking with the senators, the governor, and others in the state. How can we add money to the states of every kid born in the state of Indiana? The state of Texas just announced today they're going to add $1,000 to every account in the state of Texas, all the kids born in the state of Texas. I'll tell you, I've heard from many states now, governors or aspiring governors who want to add to those accounts. So we're going to set off a little competition in the country. And, God bless, man. This is what this country needs. It's going to unify people. It's going to get people back in the game. There's a reason less than half of people under the age of 40 believe in capitalism, Ed. Right. It doesn't work for them. Exactly. They're left out. They're left behind. They don't own anything. And if you don't own anything, it's hard to get them excited about it. So why not burn the system down and say, let's start with a new system, right? Yes. But you get people into the game. You get them winning with America, and they don't have to win at the same level as everybody else. We're not guaranteeing everybody they're going to be a millionaire, but going from nothing to something.
Yes.
Going from zero and the prospect of zero your whole life to one, that is a far bigger move than going from 1 to 5. I will tell you, this comes from a guy who had zero. I know what it feels like to be on the outside looking in. I know how it felt to go from nothing to something. So that is the promise we're going to make to all of America's kids. We're going to get you from nothing to something. And then it's on you to get out there to hustle to add to the accounts.
100%. My final question before we let you go here. I love the idea. They're called Trump accounts.
Yeah.
Did we have to call them Trump accounts? I mean, if we want, it seems like that's the easiest way to politicize the thing. Yeah. If we want to get everyone on both sides.
Yeah.
Can we call them Dell accounts? Can we call them Brad accounts?
Well, I will say this. When you look at the history in the Senate, we call Roth IRAs Roths after Senator Roth. We call Pell Grants after Senator Pell. There actually is precedence for this. I know for some people it's polarizing, but I will tell you, they would not exist without the efforts of this president. And, Roth IRAs would not exist without the efforts of Senator Roth. And so, for the time being that he's president, they're going to be called Trump accounts, and they may be called Trump accounts forever. But history is ultimately the judge, right? And history will call these what history will call them. But I, for one, think due to his efforts, I look at it. And by the way, I can tell you, he's talked to people on both sides of the aisle. He's out there talking to corporations. He's out there talking to philanthropists. He really believes in this. He said to me, it's the whole meaning of my presidency to get everybody else in the game, right? And so I know there are a lot of things people don't like about President Trump or do like about President Trump. I'm not here to litigate that battle over this piece of legislation. Yeah. The Invest America Act is unequivocally good for this country. It's a uniting feature for this country. It's a big bipartisan intent. And I'm grateful for his leadership in helping make it happen.
Well, I think it's really exciting. And I think it's really exciting that Michael Dell is contributing as much as he's contributing. I really do hope that this continues and creates something of a domino effect. Brad, really good to see you.
Great to see
Thank you for joining
and,
us.
And I love watching you all the time, man. It's amazing what you and Scott are out there doing. Keep it up, and let's. I'll come back and update you guys as this progresses.
Please
because
do.
I think it's so consistent with the platform and the message you guys are delivering.
100% agree. We really appreciate it. Thank you, Brad.
Great to see you.
So the other day, a friend asked me a question. He said, if Trump did something good, would you commend him for it on your podcast? Which I think was kind of a dig at me. He's basically saying that I'm biased or that I have Trump derangement syndrome or something. But also kind of a fair question because I haven't really praised Trump for pretty much anything. And my response to him was, yes, I would if he does something good. If he does something worthy of praise. And to me, he hasn't really done that yet. But I want to be clear. This policy is good. This policy is worthy of praise. Now, does Trump deserve the credit? I don't think so. I think he deserves maybe marginal credit. This wasn't his idea. This wasn't his agenda. I don't think his name should be plastered on the accounts for the reasons I just outlined. I think the credit is probably owed to Brad, maybe Michael Dell, who is helping to fund this. But the point still stands. These accounts are good. And the reason they're good is because they begin to address what we believe is the most pressing problem in America, and that is the unprecedented rise in inequality, the rift between what we call the earners versus the owners, what Karl Marx would call the proletariat versus the bourgeoisie. There are people who make their money through income, through labor, and then there are people who make their money through assets. And the American system, for whatever reason, is heavily rigged in favor of those who have assets, in favor of those who own things, the owning class. And this is why inequality has run rampant. And it's why the top 1% own about a third of the nation's wealth today. It leads to a loss of faith in the system, which eventually leads to some form of civil unrest, which historically leads to mass violence. And this isn't hyperbole. This is just history. Now, there are a few ways to fix this. One fix is we could just pay earners more. We could increase the minimum wage, for example. I would love that. But for whatever reason, our politics just isn't letting it happen. Another fix would be to tax owners more. I would also like that. But again, we've tried this many times and our politics doesn't really let it happen. Or we could simply make everyone an owner. We could give everyone a stake in this game that we call capitalism. And that is what this does. It recognizes the immense wealth creation with Alex Heath, again, author of the Sources newsletter and co-host of the Access podcast. Alex, good to see you.
Good to see you, Ed.
We want to get your reactions to this OpenAI restructuring, or at least the announcement of the restructuring. It's a little complicated, but that's the nature of OpenAI. Give us your read on what this actually means and what we're seeing here.
Yeah, a few things. I mean, for OpenAI top level, it means an IPO is definitely coming. I wouldn't be surprised if it happens next year, honestly. I think they want to take advantage of the hype. And if they didn't have this nonprofit structure, they would have probably gone out this year, is my guess, just given the momentum that they have. That's the OpenAI top level. The Microsoft top level is that Microsoft is essentially traded upside in equity. I mean, they still own a significant portion, but they're actually diluting their ownership stake from, I think, 32.5% to 27%. But they extracted $250 billion in Azure contract commitments from OpenAI in return. So basically accepting that dilution and upside on equity for, this massive Azure buy. So you can read into that how you will. And then OpenAI gets a little more flexibility, but not a ton, honestly. They didn't get a ton of concessions from Microsoft on exclusivity. They can use different cloud vendors, which they already were, but Microsoft still has, exclusive rights to the IP through at least 2030. And I guess lastly, that would be the other top line is we are definitely going to get OpenAI calling AGI by 2030, because a key line in this is that basically by then they'll have the ability to back out of parts of the exclusivity arrangement with Microsoft if AGI is achieved.
I have more questions on that. Just on the restructuring nonprofit versus for-profit, I think most people know OpenAI was a nonprofit, but it's not totally clear to people. Could you just give us like the history of, is this a nonprofit or is it not? And what does the history look like?
Well, the reason this has taken so long for them to do this restructuring and why attorney generals have been looking into it, there's been lawsuits about it, Elon has been suing about it, is that OpenAI has been this whole time, even the last few years, legally a nonprofit in California. What they've been trying to do is create this public benefit corporation subsidiary, which they finally are now saying they have done, to be able to offer equity like a normal company. And for people to understand, I mean, the last time we were really reminded of OpenAI being a nonprofit was when Sam Altman was suddenly fired for a weekend a few years ago. And it was because the nonprofit board had the ability to do that. And they surprised him and did that. Technically, that can still happen under this. So the nonprofit, that was a key thing in the deliberations with the attorneys general in Delaware and California, is that the nonprofit board is still, from a governance perspective, in control of the for-profit subsidiary. So that hasn't really changed. What's changed is that the people on that nonprofit board, I would say, are more friendly to Sam Altman than they were a few years ago. And obviously, OpenAI was in a very different phase. But that's a curious part of this is like the governance isn't really changing, but for some reason this is okay with regulators. I mean, the nonprofit is getting a massive stake in OpenAI, 26-ish% stake, worth a lot of money. It's the most, technically valuable nonprofit in the country by far. But I'll be waiting to see how empowered this nonprofit actually is. Is that fund, are those funds going to be liquid at all? Are they going to be something they actually use for social good use cases, whatever? I think all that very much remains to be seen. And then another just random part of this is Sam Altman still does not own any direct equity in OpenAI. Even after this restructuring, I think some people were expecting him to get like maybe 5-10% of the company as the face, and he still has no direct equity as far as we know, which is very unusual.
Just want to read you from the press release. OpenAI was founded in 2015 as a nonprofit. Its mission is to ensure artificial general intelligence benefits all of humanity. Today, OpenAI remains a nonprofit dedicated to that same mission. So they're still a nonprofit, but they own there's a subsidiary that is a for-profit, which they own a stake of. But there does seem to be a lot of emphasis coming from OpenAI that, no, our values haven't changed. We're still a nonprofit. We're still interested in benefiting humanity. The for-profit entity is a public benefit corporation. It's a B Corp. So it's kind of about, helping people. I get my BS meter goes way up when I start hearing about this.
Me too.
Okay, so I'm glad you agree. We hear about the governance, and you mention that the board still has some control. But I think what is so interesting is that's what they said last time. They kicked out Sam Altman when it was tested whether or not this was really about benefiting humanity versus making profits. The board said, no, he's flouting safety precautions, and we're going to kick him out. And then they got Sam Altman back in. They got rid of all of the board directors who didn't like him. And now they have a bunch of board directors who do like him, who are business leaders and pro-AI. To me, it all smells a little bit like BS. They say it's nonprofit. They say it's capped profit. Ultimately, this is just a company and they're going to make money. And Sam Altman may not have some equity, but he's going to make money somehow. Your reactions?
I think you're right. My BS meter is very high on this as well. I know he's already a billionaire. I know he makes fun of people who ask him this question about like, why don't you have equity? He's like, I don't need the money. There's that famous clip of him talking to senators where he's like, I do this because I love it, right? I get all that. At the same time, you are not the face of the hottest company in the world and not owning direct equity in it if you had any say in it. There's something weird going on with this. that raises the fishy meter for me, and I assume will come out at some point. But I think the big picture here, because this is very confusing, as we're saying, like it's still a nonprofit. What's really changing? The headline for me this week was the Microsoft relationship changing and how they're going to declare AGI, which was very contentious before. Basically, before, if OpenAI said, hey, we've got AGI now, then all of a sudden Microsoft would lose access, IP rights to all of OpenAI's products. And it would also stop getting 20% of its revenue, which is something that's going to continue. Microsoft is going to continue to be entitled to 20% of OpenAI's revenue. And now what's basically happened is there's going to be this independent panel that verifies if AGI has been reached. We don't know who's going to be on that panel, how that governance will work. Still a lot of questions there. And then after they say that AGI is achieved, this panel, Microsoft would only then lose access to the research that OpenAI does. So basically research into future models, but Microsoft will continue to have access to the IP. So I guess this post-AGI IP is not so important for OpenAI to fight for and have on its own as it was before. They're willing to let that also be used by Microsoft. So maybe AGI isn't going to be as transformational as we all thought. That's also my takeaway from this.
It sounds like we're going to see an absolute storm of lawsuits down the road. I mean, when we achieve AGI, who's to say what that actually means? Yeah. And I think of this as we just see. OpenAI is going to purchase $250 billion worth of compute from Azure, from Microsoft. That's in addition to the $1 trillion in spending that they are promising to spend over the next several years. I don't know if you saw this Financial Times report, but they basically learned that a lot of the deals that OpenAI is making, they're not even getting legal counsel on these deals. In fact, he's giving it to Greg Brockman, who's like the technologist, and letting him hash out these deals. This looks like the same thing. So I just want to get your reactions to, like, you know, how buttoned up are these deals really? That $250 billion number, do you believe that's actually going to happen?
Do I believe that's going to happen? I mean, do I believe that, you know, I'm going to make millions and millions of dollars next year? Like, yes, I believe it. Will it happen? Who knows? I hope so. That would be awesome. I think these numbers, including this 250 billion Azure thing, is like, if everything goes according to plan, that's the number then that you should anchor to. I would actually say that for all these deals, the NVIDIA one, the AMD one, all these, like these big trillion plus numbers that is what will happen if everything works. I think that's like the pie in the sky, best case scenario. So no, I would be shocked if OpenAI actually spends an additional 250 billion with Azure. Maybe they do. Maybe I'll eat my words there. But yeah, these deals are very much handshake like if it works right now.
All right, Alex Heath, author of the Sources newsletter, co-host of the Access podcast. And you've got your launch party next week, which I am very excited for.
You're going to be there, right?
I will be. I'm very excited. It'll be great. It's AI efforts. Ultimately, they hope to, quote, operate like the world's biggest startup. So for more on this layoff news from Amazon, what it means for the company, let's give Scott a call. Scott, good to see you.
Good to see you, Ed.
We want to get your reactions to this Amazon news. They are cutting as many as 30,000 white-collar jobs, 10% of the corporate staff. This is one of the biggest layoffs we've ever seen, certainly the biggest layoffs we've seen in the history of Amazon. Your reactions to the news?
Well, I think it's important to just set some context. I think hiring is up more than 50% since COVID. So while this is definitely a huge layoff, and I don't want to diminish the impact on the people who are getting layoff, what does this take them back, 12 or 24 months? You know, it's a dramatic top line or a headline number, but the reality is when you're growing as fast as these companies, it's good business practice to occasionally hit the pause button and reevaluate the size of the company. I mean, Alphabet has done this a bunch of times since they went public 20 years ago. And the thing that sort of blows me away here is that I think that Amazon is on the precipice of just an absolute monster quarter in terms of earnings. I don't think it'll happen in their next earnings call because they'll have to expense a lot of the severance costs and they'll still effectively be paying most of these people. But say the earnings call after the holiday season, I think what we're going to see is a replay of what I think is one of the most seminal earnings calls in history. And that's when Meta announced that they had grown their revenue 23% with 20% fewer headcount, taking the earnings up 70%. And it just sent the stock skyrocketing. I think that's what Amazon is setting up to do. And the other thing to keep in mind is this was coming, because if you look at what's happened over the last several years at Meta, Alphabet, and I don't know if it's Apple. Meta and Alphabet, their revenue per employee is up between 30 and 60%. The revenue per employee at Amazon is off, or has declined 25%. And I believe that while everyone's talking about AI, the killer application of AI may not be, getting therapy or trying to figure out, how to power an Uber without the driver in front. It might be making automation more efficient and that much more productive, and bringing down the cost of automation. So the ultimate application of AI might be robotics. And Amazon has been making these huge investments early and often, and I think they're on the verge of recognizing the return on that. It's also kind of an interesting evolution of the company, because the thing that has driven margin expansion for Amazon has been AWS and the Amazon Media Group, which is basically forcing third-party retailers to buy ads on their platform, which, as you can imagine, has extraordinary margins. But I now believe they're turning their focus back on their biggest business by gross dollar revenue, and that's their retail business. And they're about to show remarkable efficiencies at the hands of automation. So the net is, last year, every year we do a predictions deck. Last year we predicted, and we like to pick our big tech stock of the year. Last year we picked Alphabet because it was trading at a P of 17 versus the average of 24 at the S&P. Stock is up 60%. Amazon's a relative underperformer, only up 20%, which is not that amazing given the kind of the acceleration in the broader market. I think our pick this year for 26 is going to be Amazon. I think Amazon is about to, in 2 earnings calls, announce a Meta-like earnings call from last year.
Yeah. Meanwhile, trading at its lowest multiple in many years. The layoffs, is it AI? I mean, you mentioned that there's the bloat that we saw after COVID. A lot of these companies are hiring. Now they're going to get rid of 30,000 jobs. Is that AI replacing them, you think?
Yeah, I think it's essentially productivity. I mean, if you look at Europe was at $45 per employee in 1995, and the US was at $45 per employee. As we sit here today on an inflation-adjusted basis, the US is at $70 and Europe is at $45. And is it because American workers are working harder? No, it's because they are armed with technology to make them more productive. So the remaining Amazon employees, which is still an enormous employee base, I think they're now the largest employer outside of the armed services. I think they're the largest employer in America, is about to get much more productive. And I think, to your point, I think Amazon trades at its 5-year average PE is like 60, and it's down to 30 or 33. So it looks relatively cheap for a company that's the second biggest retailer in the world, growing faster than any other, growing faster than Walmart, with the number 1 cloud unit. And also, throw in rocket launch capabilities that might end up being a big growth vehicle. But I think Amazon is poised to sort of catch up, if you will, and recognize kind of some of that monster growth. The existential threat that has taken their PE from whatever it is, 60 to 33, has been that their dominant position in the cloud feels threatened because the AI component or the AI capabilities of their cloud offering are reportedly substandard to, say, a Gemini or what Microsoft Azure is offering. But I think Andy Jassy doesn't get the credit he deserves as an operator. I would describe kind of Bezos as a Jobs-like visionary and Jassy as a Tim Cook-like operator. I think he's just very focused on the blocking and tackling. But I think there's
$4 trillion yesterday. Actually, not much. The stock rose only 0.1%. It was already teetering at $4 trillion. The real rally actually happened last week when a company called Counterpoint Research published a research report on iPhone sales. a report that Wall Street was quite happy about. The report basically found that in the 10 days after the release of the new iPhone 17, sales were up 14% compared to the release of the previous iPhone, the iPhone 16. And basically, that news restored investors' faith not just in the iPhone, but also in Apple itself, the long-term potential of Apple. The iPhone is the engine of the company, and it appears sales are going up. So that's what drove the stock up. The market was very excited about this report and what it says about Apple's future. Fair enough. We, however, take a different view. We were actually less impressed by this report, in which we learned that it's actually sales volume that is up 14%, i.e. they're selling more devices, but not necessarily generating more dollars. And the reason that is important is because the main driver of that growth was volume sales of the cheaper model. In other words, many consumers of the iPhone appear to be downgrading. So the questions you have to ask here are, one, will this translate to a meaningful increase in revenue? Not totally clear. And two, how much does a third-party report on the first 10 days of sales actually tell you about the long-term trajectory of the business? And does it warrant this valuation? And does it warrant $4 trillion in market cap? We're not so sure. So yes, Apple hit $4 trillion, and yes, investors are optimistic, but we think the company is still overvalued. And we don't think this justifies a higher multiple than every other big tech company. Why? Well, there are still some major question marks for Apple. For one, there's AI. Apple is behind on AI, not just in terms of spending. They've spent $12 billion. The others have spent nearly $400 billion, but also in terms of performance. Siri 2.0, which was supposed to be the future of AI at Apple, that is still nowhere to be found. Meanwhile, they are losing talent. Several executives working on Apple's AI, they have been poached by Meta, including the leader of the foundational model team. And this is important because Apple's growth opportunities are quite slim. The iPhone has basically hit critical mass. In fact, their share of global phone shipments is actually lower than it was in the 2010s. Meanwhile, their watch sales have been falling, down 20% last year. And the growth engine that they pitched us, that is the Vision Pro headset, the VR AR headset, that has been a total flop. An estimated 500,000 units have been sold. That is essentially a rounding error for Apple, and the plans for the Apple Vision Pro 2 have actually been abandoned. Now, this isn't to say that Apple isn't one of the most impressive and dominant companies in the world and in history, really, and this isn't to take away from that $4 trillion milestone. It is incredible, but we do want to be clear about where we stand right now. The company is now trading at 37 times earnings. It's trading at a higher multiple than any of the Mag 7 after a one-time hit tied to its Apple Card deal. But mixed results weren't the only thing weighing down these earnings calls. Bank executives also had to contend with fresh political pressure after President Trump floated a proposal to cap credit card interest rates at 10%. On top of that, the sector is still reeling from the news about the DOJ's investigation into Federal Reserve Chair Jerome Powell. A lot here, a lot to unpack. We are speaking with Saul Martinez, head of US Financials Research at HSBC. Saul, thank you very much for joining us on Prof G Markets.
Thanks for having me.
So we want to get your reactions to this earnings. We've seen earnings from all the big banks here, and generally a sell-off. Any initial reactions?
Sure. No, I think the divergence between what were generally good results and outlooks and negative share reactions is telling of high expectations going into these results. So I'd characterize these results as is good, not great. Now, in many respects, the results did really validate the bull case for banks. Net interest income's growing, loan growth's picking up, capital markets revenues have been good, credit quality is good. They're managing their costs effectively. The expectations from the banks are that profitability levels will go up. As you said, though, Ed, the stocks reacted negatively. JP Morgan's down 5% since they reported on yesterday, and Citi, Bank of America, Wells Fargo were all down 3 to 5%. Now, I think this, does reflect that the big banks have become, darlings. They've outperformed considerably last year. They outperformed in 2024. Valuations are historically elevated. And I think there's some disappointment that results weren't even stronger. I think that is reflected in the guidance. The guidance that banks gave for 2026 is pretty much in line with where analysts are at, and likely doesn't trigger material upgrades from analysts. And if you overlay concerns about policy, which I expect we'll probably get into with cards, it shifted sentiment a little bit towards the bank. So I think it's a reflection of high expectations coming in, and the fact that the results were good, but they weren't great, and they're not necessarily going to lead analysts and investors to really ramp up their expectations, their baseline expectations for earnings and profitability going forward.
Just looking at some of these businesses, I mean, wealth management was a success at Citigroup, Bank of America, Wells Fargo. Some really impressive M&A numbers from Citigroup, up 84% record deal making. I'm just thinking about what Wall Street is expecting or what they wanted in 2026 and what they didn't get in that guidance. Is there a story that you think that Wall Street was expecting, perhaps to do with investment banking revenue, perhaps to do with maybe the IPO market? What do you think they wanted that they didn't see?
I think it varies a little bit by bank. Some of the elements of the results were good. But again, like the expectation, what is in the market consensus is that capital markets revenues will be strong, wealth management will be strong. There is an expectation that we may be entering into a super cycle of investment banking activity. So I don't think folks are concerned about investment banking or capital markets related businesses. I think to a large degree, though, there's probably some disappointment with net interest income. So the traditional business of banks, lending, investing in securities. And part of the bull case, Ed, for banks is that we're now living in an environment where there's positive real rates across the curve. So a lot of the loans and investments in securities that banks made in a low interest rate environment are effectively repricing to a higher interest rate environment, and you're getting a positive benefit on asset yields that's driving net interest income. And I think the expectation was that banks would be even more positive on net interest income. JP Morgan gave some guidance in December about net interest income growing 30%. I think there was some hope that maybe they would increase that. I think the same story applies to Wells Fargo and Bank of America. So I think there was some hope that the traditional revenue driver of banks, net interest income, would actually be a little bit better than it actually was. But banks are basically saying that what analysts are expecting from that, for revenues is probably just about right. And I think there was some hope that they would raise guidance and that would, lead to higher earnings estimates going forward.
Yeah. Something that we should also bring up, certainly putting pressure on these stocks, Trump's proposal to put a 10% cap on interest rates on credit cards, which the banks do not like. Wells Fargo didn't like it. Citi didn't like it. JP Morgan CFO said everything is on the table to push back against this proposal. Can you tell us a little bit more about the proposal, how it will affect these companies, and if these companies should really be worried about it?
Yeah. Well, first of all, there's a lot to unpack here, and there's a lot of uncertainties. Right now it's a social media post as opposed to an actual proposal. And there's some questions about how it could even be implemented. I think most policy analysts, legal analysts would tell you it requires legislation. It's very hard to see legislation passing on this by January 20th. And it's hard to see legislation passing that would implement a cap of 10%. And an executive order on this would likely be met with legal action. So how this would be implemented is a very big question. It would have a devastating effect on the credit card business, though. A 10% interest rate cap on lending would make large swaths of the credit card business unprofitable. Broad swaths of the population would lose access to credit. Banks cannot make money, and credit card companies cannot make money given the loss rates on credit cards with a 10% interest rate. And there would be, so you would have to see a material change to the business models. Rewards would be cut. You would see more late fees. And, for JP Morgan and Citigroup, they would be affected, right? These are important business for them. It would have a material impact on earnings. But, especially for more pure play credit card companies who do have more exposure to riskier segments of the population, somebody like a Capital One, it would be, fairly devastating impact on their earnings and profitability. I think that if I make one additional point, though, because I think it ties into what we were talking about earlier about, the bull case for banks and what's in the expectations of the market. And, part of what has made the banks so attractive to investors is the view that they're primary beneficiaries of deregulation, that the direction of travel on policy is a good one. You're going to see, capital requirements cut, less stringent enforcement from regulators. And I think this was a reminder that policy can cut both ways. It's not a one-way track to, easier, more favorable regulation. And so this really threw cold water on an important part of the bank bull thesis. And I think it was a reminder that, there are risks. And this is something we did highlight in the report very recently as one of the key risks for 2026, especially as we head into the midterm election. And if you do get a situation where Democrats do really well in the midterm election, investors will be we'll start to look to 2028, and it will be a reminder that maybe the very favorable regulatory policy that you've seen may not always be that way. But we got that reminder, I think, a little bit earlier than expected with the social media post last Friday.
100%. It is fascinating the extent to which Trump is influencing everything, including the markets and the businesses of these businesses. I mean, as you say, it's like it was all about deregulation. That was the idea, and that's what the market was getting excited about. Now it appears that maybe the banks aren't friends with the White House. Who knows? But the point being, this is what is moving the market. This is what decides the whole game. Just before we end here, I'd love to hear what we learned from the banks about Trump's investigation or the DOJ's investigation into Jerome Powell. We were discussing this earlier on in the week, and one of our guests said, it'll be very interesting to see what these titans of finance, what these leaders say about one of the most cataclysmic events that we've seen when it comes to the Federal Reserve in the past few years. What did we hear from the CEOs? Did they speak about it?
Yeah, I mean, it wasn't a topic of conversation that was, front and center. I think it did come up in the JP Morgan earnings call. I think the view of the banks, and I think Jamie did express this, was central bank independence is important, and it's important for pretty obvious reasons. So I think banks, bank CEOs will express that view. I think it is fair to say that, bank CEOs have to be, they represent the bank, and they have to be, pretty, they have to be, very judicious with what they say and how they say it. But in the current, political environment, but I think they did express the view, and they will express the view that, central bank independence is an important part, and having those safeguards, are important for the U.S. economy and important for the central bank's ability to to carry out its mission of maintaining inflation under control. So but I don't think we necessarily learned anything for bank CEOs.
Actually has some new scoop that he has just reported. Rohan, welcome back to Prof Markets.
Ed, great to be back with you. Hope you've been doing well since we've last spoken.
Absolutely. And we do want to get an update since we last spoke. I mean, last time we spoke, we saw that Warner Brothers Discovery had told its shareholders to reject the Paramount bid. They were encouraging shareholders to go with Netflix. That was 3 weeks ago. We're going to hear about your scoop, but just before that, can we just get an update on what has happened since we last spoke in these past 3 weeks?
Yeah, setting the scene, in the last 3 weeks somehow, Paramount came back again and said, look, we've made some changes. We've made our money a little bit more certain. Like you and I talked about, remember, we talked about how their money wasn't totally shored up. Jared Kushner had just left. There were some concerns about the sovereign wealth funds. So Larry Ellison, right, David Ellison's old man, actually stepped in and personally guaranteed $40 billion, a huge portion of this check, and basically said, I'm good for it. I'm here for it. It really must be wonderful and nice. And Paramount said, all right, Warner, let's give this another go. You want to come to the negotiating table, talk with us? And Warner, over the holidays, sat around, thought about it for a little bit and said, nah, we're good. We like what we've got with Netflix. And shareholders got pissed off, truly furious, because from their perspective, we're talking about $30 a share for a whole company in cash. Everyone loves cash, versus $27.75 for part of the company. So less money for less of the company. It was more complicated. It was more muddled. Warner rejected it again. Paramount said, well, okay, fine. If you don't want to do that, Warner Brothers board, we're ready to fire you. We're going to mount a proxy fight. We're going to try to take control of your board because we think shareholders are pretty pissed off about this and want a chance to get their hands on all our cash. So they did that earlier this week. Now it's come out. Bloomberg first broke this news. We've confirmed it. Several other outlets have confirmed it as well, that Netflix is pretty close to making its bid all cash. So it's trying to solve for some of the problems that shareholders have pointed out. Mostly, they don't really want to own Netflix stock, right? They want to own they don't want to own Netflix at all. They want cash in hand. Who doesn't want cash? That's where we are today. And as we reported earlier, right before we're getting on to talk about this right now, both Paramount and Netflix have been making their case to regulators in Europe, but also in the US, trying to sort of say, look, we are the pro-competition deal here. Even though, remember, Paramount, as we know, doesn't have its own bid yet. It hasn't been approved. So that's sort of where the lay of the land is as we stand today.
So much in there. I think one of the most important pieces is the fact that Paramount comes back and gives a better offer. I mean, they said before, oh, we don't trust that you have the money. Then Dad comes along and says, no, I have the money, and we know that he does. They make the offer again, and then Warner Brothers says no. And this is interesting because one thing that we saw from David Ellison before all of this unfolded, before Netflix was getting involved, before we even knew that Netflix had made the offer, is he wrote this letter to Warner Brothers saying, hey, I think you guys are biased against me. And something that you reported is that you've been speaking with shareholders. Shareholders think there is a, quote, inexplicable personal animus between Zaslav and David Ellison. This is what you wrote. So it sounds like maybe David Zaslav and the board actually are biased against David Ellison. I thought it was kind of a ridiculous statement, but it sounds like maybe it's true. What do you think?
I'll be honest. Look, remember when we first spoke, I thought Netflix had it. I thought that Paramount had not done enough to solve the problems, the real problems that Warner Brothers has. But time has gone on. They've stepped up the certainty of their financing. They've said, look, we're willing to negotiate. Please just come to the table with us and talk to us. And Warner, again, this is Warner's board. We can't all put it at David Zaslav's feet, but David Zaslav is also the CEO of this company and has a lot of influence over this board, has just said no, time and time again. No, I might add, in kind of an insulting way. I mean, their last response, as you know, Ed, was to compare it to a leveraged buyout, which is not something that sits well with anybody when you're trying to talk about how much you care about a brand, how much you care about these assets, how you want to steward these assets. When we think LBOs, we think, what private equity used to do. Let's buy an asset up with someone else's money. Let's strip mine all the good stuff out of it, and let's make a ton of cash for ourselves. Screw the shareholders, screw the employees. That's what Warner Brothers compared the Ellisons offer to. And as we reported, it was super insulting to these guys. So yeah, some shareholders really do feel, and certainly my reporting hasn't gotten to the bottom of this. I would love, David Ellison, if you want to pick up the phone and let me know what you're thinking here. I would love to understand this, but certainly the shareholders I spoke with said, look, it makes no sense. These guys have all the money in the world. And if that wasn't enough, they've got three friends, right? These sovereign wealth funds who have all the money in the world. Why aren't they picking up the phone and talking unless Zaslav has some beef with Ellison. Remember, these guys went out to dinner together. They went on walks together. They had all these conversations leading up to this auction. Ellison even offered to make him co-CEO. That's David Zaslav, co-CEO of the combined company. That's not a joke. That's a real offer, and that was in a lot of the merger documents. As it stands, Zaslav will make a ton of money off this either way. So it's left to our imaginations what we think. But this is what M&A bankers call the social issues of a deal. The price might be right, the structure might be right, but if two CEOs don't like each other, if two boards don't like each other, it's the same as real life. It becomes hard to get anything done.
Ultimately, this looks like maybe a shareholder lawsuit. I mean, Zaslav has a fiduciary responsibility to get the best price, to get the best offer. If the shareholders are saying, we think the best offer is from Paramount, and he's not doing it because I don't know, because he doesn't like him, because he doesn't like his dad, because they're buddies with the president. I don't know what it is, but doesn't that seem like a lawsuit?
Shareholders are always going to sue. In fact, shareholders already have in San Francisco. I think the very week this deal was announced.
Yeah.
Shareholders always want more money, and if they don't get the money, they're always happy to complain. What has happened, right, is this proxy fight, right? So this board fight that Paramount has threatened to kick off. And that is the easiest way for shareholders in the short term to express how unhappy they are. Now, one big shareholder, that's a shareholder called Pentwater, already went on CNBC and has said, look, this is insane. This is crazy that they're not talking. We're going to block the Netflix deal. We're going to vote to block the Netflix deal because we feel like it's absolutely crazy to turn down $30 for this company. Because remember, when we talked, the closest comp to the planned spinoff from Warner Brothers Discovery was a company called Versant. That's my former employer, CNBC, MSNBC, a bunch of grab bag assets that were leaving Comcast. That company hadn't started trading yet. And everyone kind of thought this company is going to be a better play than Warner Brothers Discovery spinoff. That hasn't been the case. That stock is in the tubes. It's terrible. And so when that happened, a lot of shareholders went, well, Versant has less debt than Warner Brothers' planned spinoff. Theoretically, it's a better, higher performing, higher end collection of assets, and it's trading like crap. No one wants to touch this thing. If that thing, that quote unquote quality asset, it's all relative because it's TV, but if that quality asset is trading so badly, what chance do I have of making up for my $2.25 off this spinoff? I'd rather go with something more certain. We'll see how this proxy fight shapes out if they even need to do it. But it's certainly, shareholders are not happy, not in the slightest.
Something you said earlier, we'll leave it to the imagination why he's not going with Paramount. You've been studying this for a while. You've been reporting on this. You're speaking with sources. Let's use our imagination. Why do you think he's saying no? Why do you think David Zaslav doesn't want to take the deal?
That's a tricky one. If I had to guess, look, Warner Brothers, the combination of Warner Brothers and Discovery, it was supposed to be a crowning achievement for Zaslav and John Malone, who helped orchestrate this deal. And that was 5 years ago now. It's 2021. You were going to marry these two assets and you were going to build something better and bigger than the sum of their parts. And to do that, they took on a lot of debt. And to his credit, David Zaslav has managed to pay down a tremendous amount of that debt. The company is far healthier financially than it was when it merged. But that wasn't reflected in the stock price, right? The stock ticked down and down and down really until this bidding war started, which, by the way, created tens of billions of dollars of value for shareholders. So kudos to Zaslav for that, in all seriousness. And then you have this guy. You've got Larry Ellison, and you've got his kid, David, who have all the money in the world. And they go and they pick up one of the most storied studios in the planet. They pick up Paramount, just like that, because they want it, because it's nothing to them. And now you're David Zaslav, you're sitting there. There's been a lot of reporting about the way he approaches the job as CEO. And there was a great story in New York Magazine about this. I think it was New York Magazine, about how he actually has and uses the desk of Jack Warner, the father, the creator of Warner Brothers. So there's some implication that he actually thinks of himself as a modern day movie mogul. And yet he hasn't really been successful in those ambitions, right? He hasn't managed to give the company the financial relevance that he sought. David Ellison, on the other hand, has an unlimited checkbook. And so you kind of have this interloper, this guy, to be fair, he's been a producer for a long time, but this guy who's never run a major studio, who's certainly never run a media conglomerate, who suddenly is buying up everything for sale. In other words, is doing exactly what David Zaslav wanted to do, but was never able to get done. That's just a guess. I haven't talked to Zaslav. I haven't talked to Ellison about their psychologies or how they feel. I would love to. That's never going to happen. So that's my best guess. But it also makes sense. It's human nature, right? You try to do something, you don't succeed at it, and then you watch someone just waltz in and do it instead of you, you might feel a little resentful. Again, totally guess, no sourcing here. But if I had to put money on something, I'd put a couple bucks on that for sure.
Fascinating. I think we could talk about this for hours. We're going to have to let you go here yesterday. And that was Delta's earnings report. So before we end today's episode, we're just going to quickly cover it now. So Delta had a pretty decent quarter. They reported record revenue. They also beat expectations on earnings. But that is quite surprising because when you dig into the numbers, what you'll find is that their main cabin sales actually fell by 7%, which raises the obvious question, how is it that they had a pretty good quarter despite the fact that main cabin sales were down? And the answer lies in the growth of premium cabin sales, i.e. first class tickets. That business grew by 9% year over year. And in fact, for the first time in Delta's history, the premium cabin business is now larger than the main cabin business. Premium tickets generated $5.7 billion in revenue. Regular tickets generated $5.6 billion in revenue. Put another way, Delta's growth is now being kept alive by rich people. Now, if you're a regular listener, you know this is a theme we talk about a lot, this divide in America between the rich and the poor, the K-shaped economy, as people are talking about it, and the extent to which that divide is actually driving the real economy. The most important data point that we flagged last year was this data from Mark Zandi, which found that the top 10% of earners in America are now responsible for half of all the consumer spending. That number has never been higher. And this shocked us, not because it was necessarily surprising to us, but because it was just such a vivid illustration of something that we already kind of suspected but weren't fully seeing. Well, now we're seeing it at the company level. Now we're seeing it reflected in the earnings of some of the most iconic companies in America, in this case, Delta. And in fact, CEOs are now outwardly acknowledging this. Delta's CEO, Ed Bastian, said, quote, "There's a lot of discussion about the K-shaped consumer. Our consumer happens to sit right at the top end of that K." And it's striking the extent to which the K-shape is now openly being recognized. It's no longer some theory that people talk about on podcasts. It is an actual reality. It is a law of business that companies are expected both to understand and also to capitalize on. And that is exactly what Delta has done here in this earnings report. And it's also why they are talking about it, because they know investors feel better if they see that your business is specifically catering products to the nation's very richest people. Those are the consumers that matter. So those are the consumers that you need to own. And that is what Wall Street wants to see. Now, to be honest, I'm not sure if this is better or worse than what we had before, when people would theorize about this inequality problem. They talk about the K-shaped economy. They discuss it intellectually versus what we have now, where people and CEOs seem to simply throw their hands up and accept it as some principle of the universe. Yeah, the K-shaped economy. Oh yeah, that's just the way it is. I actually don't know what is worse. Either way, what is clear now is we have gone from theory to reality. We've gone from bargaining to acceptance. The gap is getting bigger. The rift is getting wider. And we are now watching this play out. Chief economist at Moody's Analytics. Mark, welcome back to Prof G Markets.
Hey, Ed, it's good to be with you. Thanks for the opportunity.
So, Kevin Warsh.
Yeah.
I guess we'll just start with your reactions. What do you make of that pick?
Reasonably good choice, Ed. I think, his strength is he's been on the Fed before during the financial crisis. He was Ben Bernanke's right-hand man during that period. He's born of Wall Street. He was an investment banker, so he knows markets, lawyer by training. So I think he has all the credentials. He knows central bankers around the world, so he can talk to whomever he needs to. So I think it's a reasonably good pick.
The reaction from the markets has been kind of interesting. The dollar strengthened, stocks fell. A lot of people are saying that the market's reaction is basically telling us that Kevin Warsh is the new Paul Volcker. I just wanted to get your reactions to that characterization. Do you think that makes sense? And what did you make of how markets have been reacting?
Yeah, I don't know. I'd read too much into markets. I mean, the cleanest read is from the bond market, the 10-year Treasury yield, and that kind of moved a basis point or two. So not much of a reaction. There was a sell-off in gold prices, silver prices. Maybe I think investors were using gold and silver kind of as a hedge against the tail risk that the president picked someone else that wasn't going to be quite as respectable and good. And once it was clear that Warsh was the chosen one, those prices fell back in. But broadly speaking, I think markets expected Warsh and felt pretty good about the choice. So I think the market reaction is pretty consistent with that view.
It is interesting that, we're all wondering who's it going to be? Is it going to be him? Is it going to be Kevin Hassett? Is it going to be Waller? He went with the guy that appears to have perhaps the strongest spine. I mean, my reaction was he was kind of the best option that was on the table. He was being a little bit of a sycophant in the months leading up to this election. But overall, I mean, it seems like he's probably going to be the most independent of the options. I'm just wondering if you agree with that. And if so, why did Trump go with him? Why didn't he go with a total sycophant?
Yeah, the other choices were, I think, also good, reasonably good. I mean, you mentioned Kevin Hassett. I think he would have done just as well. I think he's got an intellectual North Star. He's an economist by training. Waller, of course, is a very good economist. I think would fight for Fed independence. I don't know the fellow from BlackRock that well, but I think generally, I think they were all pretty good choices. But you're right; it is interesting. I mean, you'd say Kevin Warsh is more of the hawk, at least historically, been more supportive of policies that would keep interest rates higher rather than lower. And of course, the president's made it very clear he wants lower interest rates. So it's unusual in that sense. But, Kevin Warsh is, I think the president said it, straight from central casting, right? I mean, he looks like a central banker. He's very smooth. He speaks very articulately. He speaks definitively. You can see why the president might like him. He comes from money, wealth. He's married into the Estee Lauder fortune, and I think that just helped. So I don't know that the president was too focused on what Kevin Warsh has said in the past about quantitative easing or what the Fed should be doing with regard to interest rates, and more focused on these non-monetary related factors when making his decision to choose him.
What do you think this does mean for the Fed and for interest rates going forward? Is this going to mean we're going to not cut rates as quickly as the president would like?
I think, here's the important point about the Fed in the current context is Kevin Warsh is just one vote, right? I mean, this is a committee of 12, and you got to get a majority of votes. And I think there's a couple, 3 votes that are inclined to lower rates almost regardless of what the economic data say. But the vast majority of members of the FOMC, which includes 5 presidents of district Federal Reserve banks, they're not going to vote that way. So I think, at least in the near future, foreseeable future, I think we're on safe ground here that we're going to get decisions, interest rate decisions that are determined by how the economy's performing as opposed to what the political environment is like. The other thing to consider is everything kind of sticks to script. Kevin Warsh won't take the chair until May, and you're already pretty close to the election. So that's when I think the president would desperately want the rate cuts. But, it's getting late in the game already. And this may drag on for longer just because of getting him through the Senate confirmation process. So I'm not sure when this really matters to the president. Kevin Warsh is going to have significant sway here, at least enough sway here to get those rate cuts that the president wants.
Yeah, I was going to ask about the Senate confirmation because Senator Tom Tillis said he would block any nominee until that DOJ probe is resolved. Of course, this was the Department of Justice's investigation into Jerome Powell, which I guess is ongoing. And he's saying not going to happen until you, I guess, shut that down. What do you think will happen with this Senate confirmation process? Do you think that this is going to be a sort of long, drawn-out, complicated process, or what does that all mean for the timeline?
Yeah, well, I think Senator Murkowski, too, also, she's a Senate Republican from Alaska. She said the same thing as Tillis. She's not going to vote for Warsh until that's settled. My sense is that the president will figure out a way to stand down on the DOJ lawsuit. I don't think that's a winning strategy. And I think he wants to get Warsh in a chair. So I'm not sure how he does it or what form that takes, but I think at the end of the day, that's what's going to happen here because there really isn't anything there. Everyone knows it, and I think the president, ultimately will decide that it's just not a winning strategy. And if there's one thing he's good, really, really good at, it's at pivoting, and I think he'll pivot here. That'd be my sense of it.
My final question before we let you go. This will be the end of Powell's tenure. What will his legacy be? How will textbooks and history books remember Jerome Powell as Federal Reserve Chair?
Well, I sure hope it's not the battles he's having with this president. That may be ending up to be, what goes down in the history books, or at least what people pay attention to. I hope that's not the case because he's been a very good Fed chair. I mean, he's navigated this economy through some very difficult times, the pandemic being the most obvious. And that was pretty difficult to navigate. And, at the end of the day, here we are. We're at full employment or pretty close, 4.4% unemployment rate. Inflation is a little on the high side, but if not for those tariffs, we'd be right back to the Fed's target. So if his goal is those two mandates, full employment and low and stable inflation, check, he did it. I think he should go down in history as a good Fed chair. And the other thing is he's the prototypical central banker. He works to gain consensus. He knows his colleagues well. He works with them well. He is the Fed, and hopefully...
it's a pretty momentous week. I mean, I think all signs point to what we've been waiting a very, very long time for, which is who's going to succeed Bob Iger. And again, we thought we all knew that a few years ago with Bob Chapek, but that obviously didn't last very long. And so I think everyone sort of believes this time Bob really means that he actually is leaving. And so, all eyes are on this succession story.
Does that explain what happened with the share price? I mean, the stock's down 7% after a pretty great earnings call. I mean, overall, it's pretty good. What explains the movement in the stock right now?
I think the fear on earnings is that the March quarter, their fiscal Q2, because Disney's a fiscal September company, and so their fiscal Q2 is not great. There's a number of headwinds. The theme park attendance looks like it's going to be flat to down. They're signaling weakness in international travel to the U.S., and they're really putting the majority of the earnings growth they're expecting this year on the back half of the fiscal year. And I think, the minute you say to investors, the current outlook is not so good, but we'll pick it up or it'll improve later, that is generally a good signal to, I'm scared they're going to miss numbers, right? Yep. And then add on to it, Ed, the other piece of this is not just is Bob Iger leaving, but again, according to press reports, and this is unverified at the moment that we're recording, but the story goes is that Iger's also going to leave before his December 31st contract year end. So just imagine you're an investor, you're hearing earnings are very back half weighted, and Bob's leaving sooner than you expected. Right? And theme parks, which is the number one reason people own Disney. Sure, ESPN and Disney Plus, but if you look at what people get excited about to own Disney now, given the size of the business, it's really about its theme park and cruises. So their experiences segment, as Disney calls it, that business facing sort of, headwinds from an attendance standpoint spooks people. And look, it may get better, but, attendance grew 1% this quarter, but they were comping against hurricanes. So organically, it was flat to down. Sounds like it's going to be flat to down in the U.S. in fiscal March Q2. And then the question is, can they actually accelerate that in the back half of the fiscal year? And I think you're seeing from investors today, they are nervous.
Yes. When we're just looking at the succession plan here, who's in the running? Who might it be next?
I mean, look, we've gone out in our top 20 predictions for the year and said it would be Josh D'Amaro, who is currently the head of the theme parks. I think go back to what I just said a minute ago. The reason investors own this stock, like I can't say this enough times, they own it for theme parks. So to choose someone who is not the theme park person, I think at this point would be strange. Dana Walden is a great executive. She's had an incredible career. She came from Fox. When Disney bought Fox, she came over. She has an incredible resume in terms of what she's been able to achieve creating content over her career. But again, if you think about what Disney is all about, it's not really about television, which is Dana's forte. And it's really not about the TV business at all. Again, it's really, I really think about Disney as really two things right now. It's the creative engine on the film side that is driving theme parks and consumer products, Disney Plus. But it really, comes down to so much of this is the high profile movie content and the theme parks. And I think that's just not her focus. And so I'd be surprised if Disney went in that direction. I mean, look, Ed, there is always a wild card that either it's a dual CEO and or that it is somebody from the outside. But again, every single data point seems to point towards it being Josh. And then I think the really big question for your viewers and listeners is this an indication of Disney pivoting? Like, will there be a strategic pivot? Are they just keeping all of the assets they have today? Again, Josh comes from the theme park segment. He's not a TV guy. He's not an ESPN sports guy. Do they reconfigure the company? And our bet is that he's going to lead investors to believe that structural change, meaning separating the companies the way a Warner Brothers has been, is in process of separating, selling a piece to Netflix and spinning off their linear TV assets. That's obviously what Comcast just did with Versant. We think there's a lot of logic to Disney simplifying its corporate structure over the course of the next couple of years. It wasn't going to happen under Bob Iger. It could certainly happen in 27 under Josh.
And would that corporate restructuring involve moving the theme parks and experiences business to its own unit? Is that going to be sort of the Versant for Disney?
No, I think you would keep theme parks and studio and Disney Plus all in one unit. So you'd have the production of movie content, the production of TV content, the distribution on, Disney Plus. You would have, the Hulu business, but then you would take ESPN and ABC and all of those TV stations and ship it off into a separate entity. And so theme park, studio, and streaming all stay in one unit. And essentially what you would call, Ed, linear TV, which I know when we're talking about, a show that streams online, seems a little bit outdated at this point in time. You would take the very profitable. Remember, these are huge profit engines for Disney. I mean, I don't want to make light of the fact that ESPN and ABC are incredibly profitable businesses, but they're just not growth businesses in the way that the other assets are. And so I think you would capitalize them differently. Maybe they would look for their own M&A over the next few years. I mean, we continue to believe that Disney, if you got rid of TV and got rid of sports, could you lean into video gaming, interactive entertainment? Think about the Epic Games where they already have a joint venture with, or think about Roblox. Like, if you think about what your, viewers and listeners and what their kids are doing, it looks very different than watching linear TV in 2026. And so I think there's a lot of rationale for why a new Disney CEO would really rethink what the business should look like for the next decade.
100%. One that we haven't gotten your views on, it's been a while since we had you on the program, is the situation between Warner Brothers and Netflix.
I haven't heard about that. What's going on there?
Just can we get your updated perspective? I know that you're going down to DC for the hearing. What are your views on the Warner Brothers situation and how this is all going to shake out?
I mean, look, Netflix is currently the winning bidder. Been selected by Warner Brothers. Paramount doesn't like it. Paramount is trying to run a hostile proxy battle to try to win over Warner Brothers shareholders. I think the challenge right now is, the approach that Paramount is taking is essentially, hey, we don't need to raise our bid anymore. We will just wait this out. We think we're going to get meaningful regulatory approval. And we think that will push Warner Brothers shareholders to pressure management to take and reconsider our bid. I think that's unlikely. I mean, just given where the Netflix bid is at $27.75 in cash, the stub, which is going to be spun off probably has more value than what Paramount has talked about publicly. And so I think for shareholders, I think unless Paramount is willing to meaningfully raise its bid, it's in a tough spot. And I'll be honest, Ed, leverage, looking at the media business, especially a lot of TV assets, legacy media, linear TV, being levered, when you need to go through a dramatic investment cycle, like if you look at Paramount, I was out at UFC 2 weeks ago out in Vegas, like they need to go through, they just spent $1.1 billion on UFC. Those are the types of big, bold investments Paramount should be making. Like they're trying to change how you think about Paramount Plus. They want your viewers to have a reason to keep coming back to Paramount Plus. Great. But to make those types of investments, not having leverage or having low leverage is a real asset. And so levering up to 7 times or maybe more to buy WBD sounds a little crazy from our standpoint. And I actually wonder if we're past the point where if I'm really looking at this, like unless Larry Ellison's willing to put up a lot more cash of his own, but levering this company 7 times, at closing before you get all the synergies, levering it that high feels to me a bit dangerous. And I think if I were sitting there, if I was David Ellison, 42, 43 years old, having, 20, 30 years, 40 years in front of me, I think I would look at this and say, I can invest and build for the future. I don't need to over lever this to buy Warner Brothers. And so I actually think there's a scenario where they probably won't just walk away, Ed. Like I think they really don't want to walk away, but they probably should. And it'll be interesting tomorrow. There is certainly a view in DC that, oh my God, Netflix and Warner Brothers is too big and scary. But, on the flip side, like look at YouTube, right? Like the elephant in the room, as you know, and we've talked about on your show, YouTube is the monster, and it's the number one reason or the number one use of anything watched on the TV is YouTube. Like that's hard to fathom. And so the reality that Netflix buying Warner Brothers or Netflix buying HBO, it is effectively, it's like a 1 point increase to Netflix's market share on the TV. YouTube is still larger. I mean, YouTube's larger than Disney. If you take Disney Plus, ABC, ESPN, Hulu, ESPN Plus, YouTube is still meaningfully larger. And so like this idea that like Netflix can't buy HBO, I understand where it comes from, but I think it is not a well-educated view on what the actual competitive landscape and what your viewers are actually doing when they get home from work, the competitive choices of where they spend their time. I think if you really look at it honestly, there is tremendous competition, and there really shouldn't be a reason why that transaction is blocked.
100%. We'll be watching that throughout the day. A lot more we could discuss, and I'd love to do it. And it fell roughly 10% in just one day. Meanwhile, silver got hit even harder, falling nearly 30%. And then yesterday, gold and silver ETFs continued the sell-off, both closing down roughly 4%. All in all, roughly $15 trillion worth of gold and silver was erased in less than 24 hours. For reference, that is roughly equivalent to about 1/5 of the entire market value of America's stock market. Just staggering. So it's getting to the point here where gold is almost behaving like a meme stock. I mean, you look at GameStop as an example, which will go up and down 10, 15, 20% on any given day. You see the same thing with meme stocks like AMC. You see the same thing with MicroStrategy. Well, gold, the most valuable commodity by market cap in the world, is now behaving in a very similar way. It's now acting like a meme stock. Same with silver, which raises kind of a crucial question here. If they're acting like meme stocks, is it possible that gold and silver actually are meme stocks? Now, this view will upset a lot of people, especially the people who are very bullish on gold and silver, the people who say that this is a global secular trend, that gold is a hedge against inflation, that it's a hedge against debasement, that the dollar is dying, people are shifting over to hard assets, and all of that might be true. But the meme stock theory tells us that the real reason that gold is surging by this much and also crashing by this much is because it is simply the sexiest trade right now. Like GameStop in 2021 or AMC after that, gold and silver are simply the next shiny objects to move in and out of your portfolio. Everyone's talking about it. Everyone's writing about it. Everyone's supposedly getting rich off of it. That might not explain the entire run-up, but it could explain at least some of it. And in fact, our friend Josh Brown, the CEO of Ritholtz, he had an interesting perspective that would support this theory. He said that the reason so many people are getting into gold and silver right now is simply because the brokerage apps are recommending them. He wrote, quote, "It's like a Spotify playlist. None of these people have any fundamental or even technical opinion on silver. They are buying it because the app is suggesting it." He then went on to compare this whole dynamic to Netflix. He said, quote, "Why did Bridgerton become a hit show? Because Netflix decided to serve it up to everyone who just watched Downton Abbey. It's an algorithm. There is nothing more to it." End quote. This is obviously a theory, and it might not explain everything, but I'd be willing to bet that it explains at the very least quite a lot. In fact, SLV, which is the largest silver ETF, is currently the top trending ticker on Wall Street Bets right now. GLD, which is the largest gold ETF, is the third most mentioned. Retail is obsessed with gold and silver right now. Meanwhile, you look at what the central banks are doing. The guys who are supposedly the drivers of this whole rally, well, as our other friend Robert Armstrong pointed out last week, central banks actually reduced their gold purchases by more than a third last year. Now, all of this would kind of align with what we said last week. That is, right after gold breached $5,000 for the first time ever, we said that the gold trade was not so much an investment thesis as it is a story. A story which, as we also said, most likely resembles some form of a bubble. Now, who knows what's going to happen to gold tomorrow? Who knows what's going to happen to gold the next day? But if you were going just off of the chart, if you were simply looking at the